Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. All right, today we're tackling a massive question. Just how resilient is the global economy to a major energy shock? With everything escalating in the Middle East, we're going to dissect the anatomy of this looming 2026 crisis and figure out what it really means for all of us. You know, for a lot of people, this whole situation feels like déjà vu. You've got soaring oil prices, conflict in the Middle East. It sounds almost exactly the same. But here's the real question we have to answer. Is this just a repeat of the 1970s oil shocks, or are we dealing with something completely new, a different beast entirely? So here's how we're going to break it down. First, we'll put the 1970s and today side by side. Then we'll look at the economic armor the world has built since then, before digging into why this time the damage could be permanent. We're also going to bust a huge myth about inflation, explore the terrifying mechanics of the global debt vortex, and then wrap it all up with a survival playbook for smart investors. Okay, so let's jump right in with that big comparison. Are we just watching history rhyme, or is this a completely different song? Now this tells a fascinating story. On the one hand, you see some good news. Oil's share of our energy mix has dropped from 46% down to 30%. That's a pretty good cushion. But look at the other numbers. The potential supply loss today is more than double what it was back then. And the U.S. financial position? It's completely flipped. America went from being the world's bank to being the world's biggest debtor. So here's the bottom line. Our energy diet is healthier, sure, but the shock to the system is way bigger, and our financial immune system is dangerously weak. But like I said, it's not all bad news. The world learned some incredibly tough lessons from the 70s. And we've spent the last 50 years building up some serious defenses. Let's take a look at the economic armor we're wearing today. And this chart right here, it shows the single biggest upgrade perfectly. We have totally diversified our energy sources. Think about it. Back in '73, oil was almost half of everything. Today, it's still vital, no doubt, but natural gas, renewables, and nuclear power are carrying a much bigger piece of the load. This diversification acts like a giant shock absorber that we just didn't have 50 years ago. And it's not just about having different fuels. We're also way more efficient. The average car today can go twice as far on the same gallon of gas as a car from 1975. And here's a huge one. The U.S. totally rewrote its own story. It went from being dangerously dependent on foreign oil to becoming a net exporter, thanks to the fracking revolution. That's a game changer for global supply. And finally, we built global fire extinguishers, like the International Energy Agency, which can release strategic reserves to cool down panicked markets. These are real, structural improvements. Okay, but even with all that armor, this crisis has a uniquely dangerous twist. To really get it, you have to understand the difference between a temporary problem and a permanent scar. This is the absolute key. A supply chain problem, like a ship stuck in a canal, gets fixed when things calm down. But this is a supply problem. The actual physical infrastructure, the pipelines, the refineries, the terminals that get oil out of the ground and onto a boat is being destroyed. You can't just flip a switch and bring that back online. And hey, don't just take my word for it. As energy expert Dan Pickering points out, fixing this stuff is a massive undertaking. We're not talking about a few weeks here. We're talking about a multi-year project to rebuild what's been lost. What that means is, even if a peace deal was signed tomorrow, the damage is already done. It creates a structural deficit in global energy that will last for years. Okay, so this brings us to the next critical piece of the puzzle, inflation. We all hear it, oil prices go up, so we get inflation. But the actual mechanics of how that works, well, it's probably not what you think. First, let's just be super clear on what inflation actually is. Real, sustained inflation isn't about the price of one thing going up. It's a monetary thing. It's what happens when central banks print money way faster than the economy can actually produce more goods and services. You get more money chasing the same amount of stuff, and poof, every single dollar is worth less. So an oil price spike, that's what's called a relative price shock. It doesn't devalue the dollar. It just forces you to change your spending. You spend more on gas, so you have less to spend on other things. You know, maybe you skip the daily Starbucks and make coffee at home instead. It just rearranges the economy. Monetary inflation is totally different. That's what happens when central banks respond to the shock by firing up the money printers to help the economy. That action is what makes the price of everything go up.
The oil shock is the trigger, but the central bank's reaction is the actual cause of the inflation that devalues your savings. And that central bank response is exactly where the second, and you could argue, much more dangerous, vulnerability of our modern world comes into play. It's a problem that just didn't exist at this scale in the 1970s. I'm talking about the global debt vortex. $350 trillion. That's roughly how much global debt is denominated in US dollars. Just let that number sink in, because that number is the fuel for a really dangerous feedback loop. So here's how this vortex spins. Step 1, the oil shock hits, costs go up, and the global economy slows down. Step 2, because the economy's slowing, governments get less tax money, so they have to borrow more just to keep the lights on. Step 3, all this new demand for borrowing pushes up interest rates, which makes the US dollar stronger. And here's the killer. Step 4, a stronger dollar absolutely crushes every other country and company that has to pay back its debt in dollars. It makes their payments impossible. This slows the global economy down even more, which brings us right back to step 1. It's a doom loop that feeds on itself. So how does a cycle like that ever stop? And for anyone managing money, how do you position yourself for the fallout? This takes us to our survival playbook. Well, when you look at it, there are really only 3 ways out of this vortex. Option 1, a total systemic collapse followed by a tidal wave of money printing. Option 2, an intentional devaluation of the dollar to help out all those foreign debtors. Or option 3, massive preemptive money printing, quantitative easing to stop interest rates from flying out of control. See the common theme here? Every single path leads to the same place, an environment where your cash is actively being devalued. So if you know the currency is going to be debased, the playbook for a smart investor becomes pretty clear. You want to own things they can't print. First, that means hard assets like gold, which has a supply that's actually finite. Second, it means energy stocks, the companies that are actually making real cash in a world with higher energy prices. You could also include digital stores of value like Bitcoin, which have tended to do well when liquidity is flooding the system. And finally, and this might sound a little backwards, you actually not to hold long-term fixed-rate debt. Think about a 3% mortgage. As the central bank devalues the currency, you get to pay back that loan with cheaper and cheaper dollars. You actually turn inflation into your own secret weapon. And the takeaway here is pretty stark. As analyst Mark Moss puts it, these dynamics are already in play. The people who understand what's happening and position themselves right now, they have a chance to come out of this wealthier. The people who wait for the all-clear signal from the news, they just get inflated away. Which leaves us with the ultimate question, doesn't it? We spent 50 years building incredible resilience in our energy system. But in the process, did we accidentally build a financial system so fragile that this next big shock could bring the whole mountain of debt crashing down? That's the data for today. Now, I want to hear from you. Is the global economy truly resilient? Or is the debt mountain about to collapse under the pressure of energy prices? Drop your analysis in the comments below. Don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.